Good afternoon, everyone, and welcome to TradeStation for today's Spotlight On webinar, where our spotlight is going to be focused firmly on Joe Burgoyne, the Director of Institutional and Retail Marketing for the Options Industry Council. In this role, Mr. Burgoyne is responsible for supporting the institutional and retail educational programs for our industry. Prior to taking on this position, Joe spent 30 years in the financial industry. He most recently served as Director of Business Development for a derivative and data analysis company called iVolatility.com, where he successfully led marketing and advertising campaigns. We welcome Joe Burgoyne today to help us with this topic that many of us find perplexing: managing risk with options collars, straddles, and strangles. Our presentation today is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss here is for demonstration purposes only. They are not recommendations. This presentation is not an offer or a solicitation of any kind anywhere where TradeStation is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. We've included in the chat panel some important disclosure information regarding the characteristics and risks of standardized options, as well as the other asset classes that we cover here at TradeStation. I urge you to click them and take a look at them at your convenience. Which brings me to the star of our show today, Mr. Joe Burgoyne. Joe's one of his qualifications includes he led the floor operations at the Philadelphia Stock Exchange. He was a star, I believe, in the movie Trading Places alongside Eddie Murphy. Wasn't that you? Or do I have the wrong exchange? I don't know. Hi, Joe. How are you?
Nah, filmed in Philadelphia, indeed. I'm great, Don, and it's good to be with you and your investors today. Thanks. That's good, and good old Trading Places. I think 1983, filmed in Philadelphia, one of the all-time classics. And we're off topic here, but if any of you have not seen Trading Places, I would strongly urge you to check it out on Netflix, Amazon, or wherever you can find it. Great flick, and all about trading, not options specifically, but all about trading and the psychology of trading. So anyway, Don, again, thank you. We're going to talk about managing risk today, really with three different option strategies. Two are very similar, but we want to be thinking in terms of always, worst case scenarios. How do I manage, my downside risk? And collars are one approach, which we'll get into, and then we'll talk about straddles and strangles as well, which are certainly in the same family, but have a little different characteristics. So, Don went through the disclaimer. Certainly, options do involve risk, and many of you understand that, and that's maybe why you're here today, to try to, maybe get a better understanding of how that risk works. I do think options get a bad rap for being, a risky product. Sure, they're risky if you put on risky type positions, but they're incredibly efficient and transparent, and oftentimes very, very liquid, great financial tools, if you use them the right way. A little bit on the industry. I think many of you know that there are 5 parent exchanges. The OCC is, I think, frankly, what sets the listed industry apart, centrally cleared. At this point, the industry, my next slide will show some of the volume levels, but it is that guarantee of the contra side that I think sets our industry apart. As Don said, I'm lucky enough to be part of the OIC, the Options Industry Council. We are the educational arm of the industry, actually celebrating our 25th year this year. OIC was founded, actually the genesis for the whole idea of investor education came out of the '87 crash. And, it took a few years, but following a few years afterwards in 1992, the OIC was formed, and, we've been out there trying to help investors understand the responsible use of the listed options product, both the benefits and the risks. And I've been very lucky, as Don said. I spent quite a few years on the floor in Philly as an option specialist. Love the markets, love options, and lucky enough to be part of the OIC now for 9 years, and happy to be with you. This actually is a favorite slide of mine because it speaks to the industry itself. Just little sidebar on the history of the industry. Started in '73 out there with Don in Chicago. The SIBO, 16 companies that first day in 1973. Many of you may know that for the first 4 years, we only had calls. There were no puts. The SEC didn't approve puts until '77. I think by '77, we had 3 option exchanges. As I mentioned, we've got 5 parent companies now, total of 15 exchanges. You can see those numbers on the left-hand side represent billions of contracts. So we went, a long time before we ever got to 500 million contracts. You can see in 2011, our volume spiked to 4.5 billion contracts. In August of that year, when the industry, when the U.S. lost its AAA credit rating, the industry did over 500 million in that month alone, August of 2011. So we've had an awful lot of growth. That really significant growth started in the 99-2000 period when investors got electronic access to the markets with the formation of the ISE, now owned by NASDAQ. And also we had that coupled with dual listing, where in the old days from 73 to 99-2000, if you wanted to trade a listed issue, you had to go to one exchange. But in 99-2000, that changed. We got more competition. Instead of one bid offer spread, you had 5 or 6 of them. That narrowed, obviously, the bid offer spreads with the additional competition. Couple that with electronic access to the markets, and look at what the heck has happened to option volume since then. At this point, and I think one takeaway to option volume, you can see how it's kind of plateaued out a little bit over the last 5-6 years, but that's at a level where we're talking 16, 17 million contracts a day. And if you remember, up until, inside of the last year, a lot of those years had historically low volatility, not a lot of movement in the markets. So really what was happening is investors, I think, especially after the 07-08 financial debacle, they started to take control of their own financial futures. And I think a lot of folks are using the listed options product who didn't consider using it before. As it turns out, volatility to some extent has come back to the markets over the last 6 to 12 months. Option volumes are up significantly. I mentioned, on average over the last half dozen years, we've been doing between 16 and 17 million contracts a day. This year, we're averaging over 20 million contracts. And that number was higher in the first quarter of the year. It's tailed off a little bit now, but still, we're averaging over 20 million contracts a day. So a lot of folks and investors are using the listed options product. And let's get into what we're going to talk about today. The collars, the straddles and strangles. We'll talk about why be defensive. We'll get into the whole covered call, protective put, and then collar strategy. And then we'll spend a little time talking about straddles and strangles and how that type of protection differs from a collar. And I think, that's really something to hammer home. The big time concepts here, are we talking about spending money for protection? Are we talking about trying to do protection that's not going to cost us a lot of money? Important concepts like that. So defense, this whole idea of risk management, can, as the slide says, win championships. Covered calls, one approach. My guess is that many of you who are using the listed option product are probably already doing covered calls. The primary use for the covered call is certainly the income generation idea. For those of you new to the space, let's be sure we're clear on exactly what covered calls are. Covered call is where you're long the underlying. And remember that important premise, every options contract corresponds to 100 shares of the underlying. That's where this idea of leverage comes in, efficient use of capital. Each option contract corresponds to 100 shares of the underlying. So with the covered call, you've got, minimum of 100 shares long, and for each of those 100 shares, you can turn around and sell a contract. Primary goal is to increase return through income generation. Typically an investor, if an investor's ultra bearish, on an underlying on the market, the covered call would not be the strategy to employ because you're only going to get so much downside protection in a covered call. Actually, the amount of protection is going to be the value of the call that you sell. So if you sell a $5 call, you'll get $5 of downside protection. If you sell a call for $1.50, you got $1.50 of downside protection. That's how it works. It's not like a put, which we'll get into, which affords you the opportunity to be out of your position at your long put strike. So the covered call writer's obligations, any call seller or writer takes on an obligation to potentially sell those shares at the strike price if assigned. Again, for folks who are new, a lot of different terms in the options business. If assigned, well, assignment is the obligation we take on as option sellers. And on the call side, that obligation is to potentially sell the stock. And I say potentially because at expiration, if the stock is not in the money, and we'll go through that with our example, then you will have just collected, the premium you took in for selling the call without having to deliver on the obligation. So that's the whole idea of assignment, your potential obligation. The slide suggests, it's an American style option. Most options in the, in our listed options world are American style. We have two styles, American and European. The American style is an option where, when you sell it, you can be assigned at any time. All right. 99 out of 100 times, it's not going to happen unexpectedly. You get assigned typically if there's a dividend coming up and there's more value in the dividend than there is premium left in the option contract. That's one example. And then the other typically is when there's no time premium left in your short call. You have in the money or intrinsic value, but no time value left. That's the other time when you can expect to be assigned. I spent over 20 years on the floor in Philly making markets, and I can count certainly on two hands, I'm not sure if one, probably between one and two hands, how many times I got assigned unexpectedly. And that was in 23 years. So, assignment and taking on this obligation is not something to fear. It's just something to be aware about. And the last bullet here is, in return for our obligation, why do you take on an obligation? Well, because you want to get paid. You want to collect the premium, the value of that option contract that you sell. So that's what it's all about. So let's walk through an example. At OIC, the Options Industry Council, certainly our favorite stock is always XYZ, which sometimes can get a little boring, but that's how it works, XYZ. Let's take XYZ at $52. Our forecast, neutral to moderately bullish, as we suggested earlier. In a covered call position, you don't want to be ultra bearish because you're only going to have enough downside protection. You're only going to have the amount of downside protection of the value of the call that you sold. So typically the covered calls are for maybe slightly bearish, neutral to moderately bullish positions. Our perspective here is we are neutral to moderately bullish over the next few months, but we want to generate some income with that capital that we've already committed to the market by being long at least 100 shares of XYZ at 52. It's $5,200. So, we have a target price for the stock. We think maybe over the next 90 days, so 3 months, maybe XYZ could maybe run to 55. Well, that 90-day 55 call is worth 175. Okay, 175. That total premium, as you can see, equates to $175, and that's because each contract corresponds to 100 shares of the underlying. So whatever price you see on the screen, as it relates to your option, you got to multiply it by 100. So you're talking about generating $175 minus commissions over the next 90 days, instead of maybe generating nothing if you don't get into the covered call position. So here's basically a P&L graph. For those of you who are in the space, you're comfortable with, graphs like this. For those of you who are not really comfortable in this space yet, I urge you, as you continue to learn, through Don's educational programs there at TradeStation, try to get to the point where you can envision, P&L graphs just like this. All right, so our little dotted green line represents the stock. Okay, we're going to make money to the upside. We're going to lose money to the downside. That's straightforward. We understand that. But that solid blue line, that's where the options come into play. All right, let's go from left to right. On the left, we see the BEP, the break-even point, 50 and a quarter. All right, well, I mentioned earlier, your downside protection is the amount of premium you take in by selling the obligation or the call. So our long stock is at, the price is $52. We're taking in $1.75, so 52 minus the 175 is 50 and a quarter. That's our break-even point. So in addition to potentially generating $175, we've built in some additional downside protection. So that's our break-even point. You see the little red dot at 55? That's where you can see that blue line going horizontal to break even. Well, why is that? Well, because if that stock, goes above 55 and or at expiration, or the stock's high enough where there's no additional time premium in the call, we are going to be out of the stock at 55 because, again, by selling the call, we've taken on the obligation to deliver the stock at 55. But if we thought that the stock was going to go to 60 or 65 or a heck of a lot higher, the covered call position would not be the position we'd put on, clearly. And that's where we'll get into the straddles and strangles a little bit later. The intent with the covered call is to generate income. And over a 90-day period, if the stock goes to 55, how much can we make? Well, we can make the difference from 52 to 55, the $300. And then additionally, we take in the 175, so we can make the 300 plus the 175 we took in. We could take in $475 over 90 days, by generating a covered call position versus just, having that $5,200 tied up, long stock at 52, making money to the upside, losing money to the downside. What do we give up? Well, we give up upside potential above, basically the strike at 55 plus the premium we took in 175, basically above 56.75, we've left money on the table. But again, the purpose and motivation for putting on the covered call was to generate income. So that's covered call. Let's go to the flip side and talk about protective puts. Why do you do a protective put? Well, I'll tell you, one of the questions I like regarding the protective put position is it a bullish position or is it a bearish position? Well, I'm buying a put, it must be bearish. Well, I kind of used to think that, but it can be both. Clearly it can be both, and we'll go through a couple examples as to explain why. But I lean towards more, towards the bullish side, and that's because, if we're wrong about needing protection to the downside and the stock takes off or our underlying takes off, whatever it is, stock, index, ETF, we've got unlimited upside. So, it's both bullish and bearish, but as the slide suggests, what the protective put does is establish a floor price at which you get to sell your shares. So it's a whole different situation than the covered call. With the covered call, we're long this stock and short the call, taking on the obligation to deliver the stock. With the long put, we're basically taking on we have the long stock position, and what we have is the right, because we're long the contract, the right to sell that stock at whatever long strike we acquire. All right. So when you're selling options, you're collecting premium and taking on obligations. When you're buying options on the put side, we're taking on the right, or we're buying the right to sell the stock at the strike. So big difference between the rights and obligations. The obligations, we get paid. Purchasing the rights, we have to pay. And so big difference there. But again, we have complete control because we're long the option, we buy the right. On the obligation side, by selling those contracts, we don't necessarily have control. We got a good sense as to when we may be assigned, but we're going to be paid for taking on those obligations. A couple quick examples with the protective put. Again, XYZ stock, it's at $65. We're bullish on the stock, and we're fortunate enough, to have about a 10% profit in it because we're long from 60. We want to limit our downside risk with that $60 investment. So we decide to buy a 3-month 60 strike put for $1. So that total premium is going to be $100. Again, the dollar times the 100 shares gives us $100 premium. So take a look at the stock on the left-hand side. It's basically the left-hand side and the right-hand side of the keys here. As I mentioned, you can see, you can see the stock at 60. That's where we started with this thing. If we pay $1 a premium, for that put, and the stock expires at $60, then we'll have given up that $100. That's why we lose $100 at $60. The good news is, and maybe the stock, obviously it had a run from 60 to 65. We don't really get into whether it had a run from 50 to 60 before we bought it at 60. But to the downside, you can see at 55, we're only going to lose that dollar because we have, committed that $100 to protect us on getting out of the stock at $60 if the stock turns and heads to the downside. But as I mentioned earlier, that whole question of, is a protective put a bullish or a bearish strategy? That right-hand column is really why I lean towards a bullish strategy, even though we're buying insurance and buying protection. That chart in your mind shows you, boom, to the upside, we're still making a boatload of cash. We've got unlimited upside. So at 65, we're going to make still that $4 in the underlying. It's not $5, because we paid $100 for that $1 put. And at $70, if the stock keeps running, we're up $9. And if the stock goes to 75, it's going to be 14. So we acquire downside protection, but we're still long the stock. So we get to share in all of the upside. Again, conceptually, the big differences, between a covered call where we get paid versus paying for downside protection. That covered call, we take on the obligation in that example to get out of the stock, right at 55 versus, being able to just sell the stock at 60 with the long put. So key differences. Those of you who are in the option space, you understand that. Those of you who are new to it, I'm just trying to go over it a couple times so it's crystal clear. Again, I'm a huge believer. Even though I've been in the option space a long time, like Don, I think they get a bad rap. A lot of people say they're so complicated. We're just talking about a lot of simple math here once we understand the concepts, what are the rights? What are the obligations? Every contract corresponds to 100 shares. This is not rocket science, but what's critically important is just understanding the core concepts and then, nurturing your education, into some of the different strategies. We frankly use options for two reasons. I mean, some would say three, but primarily two: income generation, and then the focus of today's conversation, risk management. Some say that, options are used for, there's a leverage component. Speculation, sure. Some people use options for speculation, but really, the vast majority of those 20 million contracts that are traded today are about income generation and risk management. So again, trying to get these P&L charts in your head as you mature as an option user. You can see that green dotted line. That's the underlying stock. We're making money above 60. We're losing money below. You can see, how the blue line represents the protective put position. We're going to be out at 59 bucks. On a net basis, we're out at 59 because we paid $1 for the 60 put, but we share in all the upside above 61 as the stock, heads to the downside, or excuse me, to the upside. So that's put example number one. Number two, a little bit different, same stock, still trading at 65, and we're cautious, just like we were before. But we want to lock in some of our profits, okay? And, the first time we were only talking about protecting our downside. Here we're actually talking about locking in profits. And that goes to strike selection. And I mean, Don may agree with me. To me, the two, I'll call them challenges, but at the same time, to me, it's what makes option trading so much fun. What strike, what month? They're the two key questions. And, these two examples speak to that what strike perspective. First example, we're just looking for downside protection. Second example, we're looking for downside protection, but we want to lock in some of these profits that we have in the underlying stock. So rather than buying a 60 put, we decide we're going to pay $2.50 for the 65 put. All right. So rather than paying $100, we're paying $250. But look at the difference in terms of our downside return. At $62.50, we'll be able to lock in $2.50. At $60, the same. All the way down, we're locking in at $2.50 because we're fortunate enough to buy the stock at 60, have it go to 65, and able to buy that 65 put. The right to sell stock at 65. That's what that $65 put gives you. The right to sell stock at 65. If we only had to pay $2.50 for it, you take the strike price 65 minus the premium paid, takes us to $62.50. Well, we paid 60 for the stock. That's where we're making $2.50 to the downside, no matter what in this thing. Again, the motivation was to lock in profits, not just purely downside protection. But as you can see, at 70 bucks, we're still benefiting with all the upside. We're up, $7.50 at 70, would be up 12.5 at 75, and so forth. So that's the protective put strategy. Again, here's how it looks. You can see that blue line is $2.50 above break even because, we're locking in $2.50 of profit by paying $2.50 for the 65 put. So covered calls and protective puts equals the collar. Collar can be considered really two strategies in one. That's why I spent a little time going through, both strategies fairly thoroughly. The collar is a combination of the covered call and the protective put. And that first little bullet speaks to the essence of why I think so many investors like the collar, and that is, by selling that covered call, you offset, it depends on your strike selection. A lot of times investors are trying to do these collars for, a credit or for net $0. But by selling the covered call, you offset the cost of that downside protection. Most investors typically get into the collar position after, they've had a run up in a stock, that they bought lower. So they're looking to essentially lock in some of those underlying profits without spending an awful lot of money or any money for the downside protection. All right. Typically, you're selling an out of the money call. Oftentimes, it's an out of the money call and an out of the money put. But remember that by selling that upside call, yes, we are offsetting the cost of the protective put position. But what are we giving up? We're giving up our upside. Going back to those charts, the protective put, you participate to the upside. When you get into the collar or the covered call, you do not get a chance to participate to the upside above the short strike that you've sold. Hope that's clear. To the downside, we know what the protective put's all about. So it's really a combination of just combining the covered call and using the protective put. So let's go to an example. Here's one with the zero cost collar. Essentially, we're looking at being long 100 shares of stock. In our example, it's 61.5. And I'm sure all of you joining us today, you've got your favorite stocks, indexes, and ETFs. You may already be using collars. If you're not, and you're active in the options market, the distance between the call and the put, that you have to buy and sell in order to do these things anywhere for even money. That the skew in the options marketplace makes puts more expensive than calls in almost all situations. So, you've got to sell calls typically closer to the money and buy puts that are further out of the money in order to be able to do these things for zero cost. But that's just how the marketplace works, and the skews that are involved in each, in pretty much all underlyings. But in our example here, we've got the stock at 61.5, and actually this speaks to that. So if we had no skew in the marketplace and we were equidistant between the call strike and the put strike, we'd be at $60. But here we are. Stock's 61.50, so $1.50 higher on the call side, would maybe get as close to a zero cost collar. And that's typically how these things work. So importantly, the collar is three pieces. It's long the underlying, it's short a call, and long a put. The collars typically are done same month, but if you're managing things pretty closely, there are a lot of other approaches. I mean, I think, again, one of the almost negatives on the option side, there are so many different names for the types of strategies that are out there. Understanding, what long puts, short puts, long calls and short calls, mean inside of your position is paramount. Trying to be crystal clear, what your underlyings are. Does it make more sense to be long push, short calls? Do you want a combination of the two? That's where I think, your focus should be. And, whether you want to be same month or not, there's a thought process out there that, you can buy the further out put and sell front month calls against it. It's a bit of a bastardized collar, but, there are a lot of different ways to approach these things. But most importantly, look at your upside, look at your downside. Try to never be in a position where you're surprised about, either making money, but especially losing a considerable amount of money. The tools, that Don has at TradeStation there for you. And, we offer a lot of wonderful tools at the Options Industry Council website too, at optionseducation.org. Give you the opportunity to, see your portfolio, your individual issues, up and down 10, 20, 30%, with a significant change in volatility. Check these things out. They're free to use. You just need to commit your time. I mentioned volatility. I know this is not a presentation on volatility, but always be aware of, whether you have volatility exposure or not. And actually, I will get into that as we start talking straddles and straddles. But in the collar, long the underlying, long the put, short the call, not a lot of volatility exposure in a position like that. So I hope that's helpful, in terms of understanding how we get to the collar. We start with long underlying, short a call, long a put, and away we go. Downside protection. You can do it. You can do them for credits, even money, or for a debit, depending on the strike price selection. So let's roll into, from the outside. I said we got a couple different ideas on protection today. The collar we just went through fairly thoroughly. The other two approaches are going to be a straddle and a strangle. Many of you probably know what straddles and strangles are. Why get involved with a straddle? Well, we're talking about risk management here. So, being long options gives us protection. And whether, it's just a call or a put, we're going to have upside or downside, opportunity. A long straddle is where we are long a call, long a put, same strike, same month. That's a straddle. Very straightforward. Basically, when we put on a straddle, we are either looking for protection or a spike in volatility. Well, why would we care about volatility? Well, because we're long two options. For every straddle, we're long. Long a call, long a put. So you better believe volatility comes into play, with this type of protection. Both volatility and then, I hope right away you're thinking, well, it's not just volatility. We're long two options to give us protection here. So we're buying insurance, but that insurance doesn't come for free. The good old Greek theta, cost, of decay per day is a huge factor, in terms of being long a straddle or a strangle. And that's why from the outset I said, we'll talk a couple different types of risk management protection here, but they're very, very different. With that collar, we're talking about essentially doing them, for zero cost, even though, you can spend some money or take in some money, but bottom line, not a significant cost. When we start talking straddles and straddles, depending on whether you're talking front month or further out, you're talking about, in advance of earnings or after, we're talking about a lot of coin here, a big time commitment, a big, potentially premium for the right to have your protection. And that, to me, is the big takeaway here. It's, straddles and strangles can be great positions, but you got to know you're putting up usually a significant amount of money. And if that stock doesn't move, chances are it's not going to be a pleasant experience. So anyway, what are we looking for? Why be long a straddle or strangle? Two key reasons: big stock or index, expected move, or a big move in implied volatility. Let's go back to XYZ. We'll go with an example. We got the stock at 87.50. We got a month and a half to expiration. So 87.50. So we got, we're going to buy a call, buy a put. All right. And I never pay attention to the individual prices. All I care about is, what's my debit? Okay. We're buying calls and buying puts. So we're putting out cash, 45 days. It's $4 per straddle. That would be $400 for every straddle we're long. Now, thinking in terms of, the charts, those P&L graphs, try to envision them in your mind. Actually, a P&L graph is going to be just like that flock of birds, I think you probably realize. Maximum gain, unlimited. Maximum risk is the $400. Okay, it's the great thing about long options. You know the maximum loss from the outset. Worst case scenario is the debit you pay. Nobody wants to pay $400 and have it go to zero for sure, but at least we've got finite risk. Okay, we've got our margin, and then our all-important break-evens. And when I talked about envisioning, those P&L graphs in your head, go back to that covered call at $52. We sold the out-of-the-money call for $1.75. Where was our break-even? Clearly it was below 52. It was 50 and a quarter. With our straddle here, we're 87.50. We're paying $4. So we're $4 from the strike. Above and below, there are break-evens. Simple math. So above and below 83.50, above 91.50, we're making money. That's why we put on this position. And in addition to a big stock move, hopefully we get a big move in implied volatility and win two ways. They're the motivations, plain and simple. There's the chart that I'm asking you to try to figure out in your head. All right, so current share price 87.50. You can see that V goes well below the break-even line. $400 divided by 45. We know, it's not symmetrical in terms of the amount of money we lose on that $400 straddle over the next 45 days. We start to lose a little bit as we get to, 40 and 35 and 30 days. Inside of those last 25 and 20 days, if that stock's not moving, the value of that call and put are getting hammered, and the value of that straddle is getting hammered at the same time. So that's where having a plan, the motivation for putting this thing on, but how you bought 45 days. When you bought 45 days, were you planning to hold it for 45 days or bang? I bought 45 days. If I don't get my move in 20 days, either in implied volatility or the underlying, I'm out. You got to have that plan in advance. Otherwise, it's just really, honestly, just not a good way to use the product. Is my take on things. But you may have a different take. So that's the long straddle. All right. I hope you're clear on that. We'll go through the strangle. That is very similar. Has the same benefits to the upside and downside, but one key difference. So same thing. We're long a call. We're long a put. Instead of being long, the same strike, we're going to be long two different strikes. Same motivations. We're looking for a big move of the underlying or move in implied volatility. So therefore, we're long two options. But difference being, stock's still 87.50. We're buying out of the monies. So same 45 days, so same time frame. We're buying an out of the money 90 call. We're buying an out of the money 85 put. I hope it's clear to you that both of those options are in fact out of the money. The 90 calls the right to buy stock at 90. Stock's 87.50, out of the money by $2.50. That 85 put represents the right to sell stock at 85. With a stock at 87.50, that's $2.50 below the price of the stock. So that too is $2.50 out of the money. So they're out of the money options rather than at the money options. So clearly they're going to be less expensive. The call $1.20, the put $1.30. Again, doesn't matter to me what the individual prices all are. I just am interested in that net debit, which is $2.50. So a significant reduction to the $4 debit we paid for the straddle. So that's, again, part of the fun with which option, what month, what strike. You can go and buy the straddle or you can buy the strangle. Importantly, I think in analyzing what is the best choice, you look at your break-evens. Break-evens, frankly, are not that significantly different than the straddle, but the percentage difference of the debit between the straddle and strangle is significant. So, in your analysis, that's just the type of thing that you want to consider. If you want to be long options, have the benefit of, getting long to the upside and short to the downside with a straddle or strangle, which is exactly what happens. You get long to the upside and short to the downside because you're long both the call and the put. Analyze which ones, makes more sense. And again, Don and the crew at TradeStation have all kinds of good tools that can help you in your analysis. So here is how it looks, and you can see the key difference, rather, with that blue line, which is a picture of our potential P&L. With the straddle, we had that V formation because we were long the at the money, 87.50 strike. The difference with the strangle is that we're long the out of the monies, so our break-even points are a little different, and we have the difference between the two strikes that were long, which shows up in the blue graph as well. So Don, I think that's the conversation about collars. One form of protection that doesn't have to cost you a lot of money. Typically, they're initiated when somebody has, a run up in an underlying and wants to lock in their profits, and then depending on strike, can do it for a debit, credit, or $0. Those straddles and strangles afford wonderful protection, but clearly a whole different commitment from a capital standpoint. We're spending a lot more money for that insurance. One thing I didn't say that I'll just add maybe before I turn it to you, Don, is that especially for those who are a little more advanced in their options, when you're long a call and a put in a straddle or a strangle, you can always sell any option against those positions. So if you're long the, and it really doesn't matter what options you sell, as long as you don't sell, more calls than calls you're long or puts than puts you're long. So the stock moves in one direction, you can sell a call against that at the money call in the straddle, or sell, maybe a further out of the money or in the money call against, in our strangle example, that 90 call. You have lots of flexibility. Don't be afraid to hedge your long option positions after you've put them on by selling options against those long option positions. Just be sure not to go naked net short calls or puts, because then you take on a whole different risk profile, and Don will likely be calling you to add a little more capital to the account. So with that, Don, I guess I'll turn it back over to you.
Thanks for the reminder. That is making those margin calls is one of the worst jobs I ever had. But yeah, Joe's absolutely right. That kind of risk, not managing your position, could lead you there, and so you want to make sure that we do manage our risk. Now, the mission of the Options Industry Council is to increase the awareness, the knowledge, and the responsible use of exchange-traded equity options among a global audience of investors, including individuals, financial advisors, and institutional managers, by providing independent, unbiased education and practical knowledge. Thanks to Joe Burgoyne today for helping the OIC meet their mission statement today and helping everybody here at TradeStation get to the bottom of the options questions that everybody needs. I want to thank Joe, and hopefully we'll be able to get him back again before the end of the year. His travel schedule's busy, but we like to make time for our partners in education. So thank you, Joe, and thanks everybody for attending today. I hope that this was beneficial to all of you potential option traders here at TradeStation.